Hi, this is Michael Jones, Chairman and CEO of Caravel Concepts. Welcome to Market Insights, our weekly commentary on financial markets. Let's get started. This week, we want to address a question and a concern that's been expressed by a lot of the people who are commenting on some of the videos that we posted in recent months. So we've been very, very clear. The US, through the Federal Reserve, has been printing trillions and trillions of dollars and injecting them into financial markets. And we're seeing wild and crazy things like GameStop stock going through the roof and then crashing back down to earth. And, despite all these crazy things we see happening, people look at the broad market where a lot of us are invested in more conservative, mutual funds and ETFs, and they say, gosh, it just keeps on going up. Is all the craziness, all the money printing, could that somehow, some way stop this wonderful upward trend in financial markets? And what we need to recognize is that when a central bank prints money and injects it into financial markets, stock prices tend to go up. And you can see why. There's the same amount of stocks in the market. There's more pieces of paper called dollars chasing them around. That pushes prices up until and unless you get inflation in the broad economy. And that's when the magic stops. That's when you can print more money and stocks don't go up. They actually start going down because they worry about inflation. And when you hear printed money, a lot of people who know their history, they start worrying about inflation. Because you think about the printed money that Germany was using to survive the aftermath of World War I. And they had hyperinflation. Like literally inflation rates in the millions, where people were taking wheelbarrows full of Reichmarks to buy a loaf of bread. Or more recently, you've had places like Zimbabwe and Venezuela right now today, where they printed so much money, prices are rising so fast that prices go up between the time you walk into a store and you get to the cash register. So the first thing I think we should just put out there without question and without equivocation is I don't think there's much chance that the US experiences that kind of devastating hyperinflation. But what about the inflation we had when I was a kid in the 1970s? Could we see that? Well, I had a professor one time that used to say that anything that has actually happened is probably possible. And so we have to acknowledge that the inflation we saw in the 70s, we've had it in the past. We've actually had it twice in the past in the last 100 years because we had similar inflation, actually a little bit worse, in the late 40s and early 1950s. So there have been two times when inflation has been not the 1.5, 2.5, 3 that we're used to in the last 20 or 30 years, but it was 5, 7, 10. That's a long way from Zimbabwe. But it still would be enough to make the stock market incredibly unhappy. So what are the prospects that we see that kind of inflation in the United States? Well, let's take a look at what is similar from now and back in the 40s and the 70s, and what is very, very different. So what is similar is that in the 1940s and in the 1970s, the Federal Reserve was printing a lot of money when things were not so bad. Unemployment wasn't very high, the economy was growing, and yet the Federal Reserve was printing a lot of money because the government had a lot of debt after World War II. And in the Nixon era, it was what he called guns and butter. I'm going to fight the Vietnam War and a war on poverty. So government was borrowing a tons of money, and the Federal Reserve was making that easy by printing a ton of money. All right, that's kind of what's similar between then and now. All right, what is very, very different is that the shock that the US economy took after the Fed started that money printing when things were okay, There was a shock in the 40s. The Cold War broke out and suddenly we were spending tons on defense. And then there was the Korean War and we were spending tons on tons on tons. And in the 1970s, we were printing money when things were pretty good. And suddenly there was an OPEC oil embargo that drove oil prices higher. A lot of people thought that the inflation came from the oil prices, but actually that wasn't the case. Their oil prices went up all around the world, but France, Germany, Japan, they didn't have inflation because their central bank wasn't printing money. Ours was. So we got inflation. So think about 40s, 70s, Fed starts printing money when things are pretty good, and then there's a shock that's inflationary, that pushes prices up. All right? That's the big difference between the 40s and the 70s and now. Because did we start printing money when things were okay? Yeah, absolutely. We started printing money in September of 2019 when unemployment was 3.5%, the economy was chugging along at 2.5%, 3%, but we had a $1.4 trillion deficit. That's a huge deficit in a time of low unemployment and reasonable economic growth. And because people were wanting to buy cars and houses and the government was also trying to borrow a whole lot of money at the same time, interest rates were going up. And there were parts of the bond market where interest rates were going up catastrophically. There's a part called the repo market where interest rates actually hit 10% one night. And that really freaked the Fed out. And they said, you know what? I know unemployment's low and I know things are looking fine on growth, but my gosh, we need to start printing some money or interest rates could go up and that would derail everything. And why is that a concern? Because essentially the Fed is using their strongest medicine when the economy's not doing so bad. And so the Fed started printing $100 billion a month in September, October, November. And then 7 months later, we get a shock. But it is not a shock of a lot of huge defense spending that suddenly stimulates the economy like the 40s and early 50s. It's not a shock of a huge increase in oil prices that ripples inflation all through the economy. No, it's quite the opposite. This is a shock of COVID-19 and having to stay at home and lots of businesses in terrible trouble and a lot of people losing their jobs. It's not an inflationary shock, it's a deflationary shock. So that's a huge difference between now and the 40s and the 70s. And that has given the Fed permission to not just print the $100 billion a month they were doing back before COVID. They actually printed about $2 trillion in about 6 weeks. They've never printed money that fast since World War II. And they injected it in the economy to finance a big stimulus package. And so I think the prospects for high inflation short term, not a problem. Does that mean you shouldn't worry about it at all? No, unfortunately, I wish I could tell you that. But the problem is remember, we started printing money before COVID. There will be a moment when we've all been vaccinated and COVID hopefully will no longer be this huge problem in our lives. Right? There won't need to be any more stimulus package. The Fed will not need to be doing this huge injections of cash so that we can put $2,000 checks out to the American people and things like that. But the deficit that was there before COVID will be there after COVID. And so will all the trillions of dollars that the Fed printed to get us through COVID. Can the Fed stop printing? Can we run a $1 trillion, $2 trillion deficit? Because that's what it's going to look like. That's what Biden inherited. And if you remember in the election campaign, we had a $4 trillion deficit and it wasn't even mentioned. President Trump didn't bring it up, obviously. President Biden didn't bring it up because he doesn't want to have to cut the deficit either. And he doesn't want the Fed to stop printing money. So the real question is when COVID's passed, when the deflationary shock is past, can the Federal Reserve, do they have the strength? Do they have the independence? Can the federal government withstand them turning off the printing presses and financing the deficit at whatever interest rates have to be to finance the deficit that we'll be left with? If they can, then inflation won't be an issue. If they can't, then we're going to be making a bet. Because there is one country that has run deficits and deficits and printed and printed and printed, and they still don't have inflation. As a matter of fact, they're still fighting deflation, and that's Japan. So there's 2 escape hatches from the inflation that would interrupt the stock market. It could be that Washington has the strength and the resolution to stop printing the money once COVID is out of our lives. And if they don't, it could be that because the world population is aging, technology, all the things that people have tried to use to explain why Japan has printed tons of money, funded huge deficits, and doesn't have deflation, maybe the whole world will behave like Japan, and we can keep printing and there still won't be inflation. If we don't go through either of those escape hatches, then there could be a bumpy end somewhere out there when inflation gets back to the kind of levels that it got back to the last time the economy was okay, but we couldn't turn off the printing presses. Thank you for joining us for Market Insights. We hope you found it informative. If you'd like to see more of our research, you can subscribe to our YouTube channel at the link below, or you can check out our website, caravelconcepts.com. Thanks.